Hey guys, how are you? I don't normally have time to do especially a YouTube answer for tweets, but there's some things that are slightly high value or triggering that really need stamping on that I will sometimes occasionally elect to respond to because it's a misnomer that I like to rectify. So this gentleman over here has done a request. By the way, my crypto handle is the Crypto Sniper, but you're welcome to follow the Market Sniper as well. Bitcoin has completed. He wants some form of comment on this tweet. So if you go to that tweet, this gentleman has stating that there's completed a full retracement of the drop Bitcoin since the 14th of November. We remember it well. We were doing a theory weekend on our program on the 11th and reiterated it to sell for both it and Ethereum, which gave us over 60 RRR. In other words, there was a clear defined stop, a clear defined target, and it was made exceedingly quickly. Anyway, all that aside, the tweet says you would have made more money buying the bottom at 3122 at 6,300 over 100% than if you had shorted the top perfectly and closed at the bottom 84%. In other words, 19,666 to 3,120, roughly 84%. It's call it 20, depending on your exchange, 20 to 3 grand. It's 85% in the whole. And here's the problem with this tweet. Many people go, there's a number of conclusions people come to. The conclusions are, yeah, you make more upside. The upside is unlimited, while the downside can't go lower than zero, and Bitcoin isn't going to fail. So, even if it goes to back down to $1 or as we did 3,000, you've lost 85%, but you'll gain all those 100%. Here's the problem with it. It's the mathematics is given is correct, but the overall trading rationale is entirely damaging because it encourages people just to out and out hodl. And the key point to understand is that the 100% you've made, for most people, he's taken selected pieces of data. He's saying it's better to go from 3 grand to 6.3 and make over 100% than to try and make 84% on short. One of the key elements about getting short, what happens first is that people, before you short, there's usually a point where you're bullish. Then you start to become concerned about that bullishness. You get square, and then you get bear if you know how and you're capable, right? Now, one of the key elements of what would have happened in the melt up in Bitcoin to $20,000 is once you got concerned afterwards and it had a smackdown. Let's refer to the chart first of all. Is you first would have got square. Now, the value in getting square means you get mentally neutral. Mentally neutral. Mentally neutral now means A, you've stopped losing money if it goes to the downside. So if we just go back up to a much bigger time frame and capture the blow off, what ends up happening is your high water mark of the equity at the $20,000 mark, after you've had your first major slapdown, let's say you never panic, sell, and you always typically, you can never say 100% always, that's absolutist talk, but you usually in markets get a second chance. Now my view is after this extensive smack from the $20,000, when you went all the way down in panic to 10,000, and then you had these successive rallies back up to 16, and then it did it again, and then you had a successive rally up to 17,000. There were true opportunities here where you would have realized the volatility has got off the scale. So even if you had hodled up to the 20,000, you had no targets in place at any point, you were on an all-time equity high, and let's say you were 100% Bitcoin, which isn't the case. Most people would have had a huge percentage of alts because alts were even further outperforming Bitcoin. So I'll come back to that point, but let's just park it. Let's say you were worth 100K at the high point of your Bitcoin and your mainly Bitcoin. You could have got out at least there or anywhere there. So selling into the rally. Hard to do because you panic sell and you panic buy, but you would have recognized the volatility if you have True Method, part of a community that identifies and recognizes volatility in prices, the key elements of signifying future direction. Let me say that again, not quite so fast. A community that understands volatility as a key indicator of potential future price direction. Hear that one more time. Volatility is an indicator of future price direction if understood with a real method. You would have got out on the rebounds and you would have been square. You would have held on to, if you were getting out at the 17,000 or even the 16,500, the 82% of your 100K. So you'd be sitting on 82.5K. The concept of this guy saying, well, if you had bought perfectly at the low, which in its own case there would have been no reason to do, I would have expected, as I did, the potential for further continuation exists and was the dominant theme, and you got out at where we are now, where you get his 100%, is actually you would be getting 100% of your 100K that's lost 85% and is now 15K. The truth of the matter is what he ignores, for most people to be long at 3122, they've held it all the way down and have shed 85% of their equity. The likelihood that you showed up and said, that's the low, I'm buying at that point, that 100% is worthless if it's 100% or 15% of what you had. So just by getting square, you held on to 82K to this point. Let's say you're only getting long when key technical levels are being taken out. You're doing so from a base of 82.5K. You've had none of the negative emotionality, or a small portion, a minority of the negative emotion the bulk of the guys have had getting down to that level. Do you think if you rode all the way down here that at some point you finally would have just capitulated and exited and say, I can't bear this bad news central that just keeps coming at me all the way? Eventually, yes. So they probably would have locked in their 85% loss. Now, if you go and if you ever took the time to do our free webinar, by the way, I talk about a concept called the recovery ladder. This is a simple aspect of valuing capital management. In other words, managing your losses is the most important thing you do. Keeping them small. So in other words, at any point that you've lost 5%, if you're looking at this over here, I'm not sure if I'll be able to draw on the PowerPoint slide as well. At any point you've lost 5%, to regain your former high, you have to make 5.26. Let's shimmy on down to the red zone, shall we? The red zone, 85%. I've put it in there. And in actual fact, you're going to be knocking on the door on needing a 7x to get back to where you once were if you allow an 85%. Now, apart from crypto markets, those kind of losses are never recovered, and I would say generally aren't even recovered in crypto markets. Why? Because people have used leverage. Why? Because they weren't 100% in Bitcoin, and in actual fact, if I take a coin, for example, that was in the top 5 and 6 when I did Consensus in New York 2 years ago, round about this time, it ended up on a 98% loss. Believe it or not, it went even lower than that. Bitcoin is the best hodled loss you had at 85%. The very best if you didn't do capital preservation. It means that you're almost a genius as a hodler for only losing 85% of your high water mark. Does that 100% from 3K back to 6K now look a little bit less awesome? Because you ain't going to be buying at 3K on the bottom when all you've seen is down, 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 and the bear trend is bear, and the news is bear, and no one is seeing any upside, and it seems relentless. People's mindsets in the absence of method are not strong. There's disbelief right now out there still in terms of what key levels are being run. In other words, they lack the ability to flip, and once they get into a state of disbelief, it's really hard. They sit there and it becomes a hated bull market for them. They don't understand it. This is the inability of self to show flip. I say learn to flip or flip burgers. You've got to decide. And the concept requires you to be able to move, baby. You've got to be a fruit fly. If key levels that have been volume highly endorsed with massive participation are being taken out, this happens. And this is when people come out with fundamental narratives. Oh, but it's market manipulation. It's this. Listen, there's massive participants in all markets. They're all manipulated. Forex is manipulated. Central bankers are playing in there. But you know what? They are still participants. They're just big participants in the market. Someone's got to buy, and most are commercially directed. This is why. It's our inability to recognize that things have now changed and are playing out. So the recovery ladder is a huge aspect of this. You wouldn't be a buyer if you were here. And the percentage, the implied percentage is you make 100%. This is an aspect of financial mathematics. A shorter can never make more than 100%, even if something goes to absolute zero. Of course, leverage changes that immensely. We took 6 digits out on the short side in Bitcoin in just a single setup. This one right here that we've got over there. And not myself only, but members in our community, to the point that they were somewhere even saying, you know what, I came here wanting crypto to keep going. I love this bear market. I can't wait for it to go lower. It can go to 1K. I'll deal with it. And he now framed in bear. Now he has to reframe potentially in bull. But the key point is you would not have been a buyer at 3,000 if you weren't at least square or bear from down here, because you would have been so battered and so buggered in the head and emotionally that you wouldn't want to buy this beast that keeps punishing you. So the key element is, if you don't understand when to take off in exceptional markets, you will have to eat every bear market in its entirety. And you don't have to make regular decisions. You don't have to be a trader. You can be an investor. And you can just make one big decision every 18 months or year. And providing it's based in quality and real method, and is dispassionate and sees the disbelief of the bull market now, and saw the disbelief that you should be taking money off the table in December 2017, that is something that only you can learn in time to do. But the key mistake here is, to get square, to get bear, you first have to get square. And learning that there are moments where bear was value, we rebuilt up, not getting out of at the high. And let's say it was 100K we held just for a nice unit of money at the 20K mark, and you get out and you're holding 75 to 80. We actually got huge benefits out of that short that recapitalized us towards all-time high potential. And then you're in a bull state of mind and you're ready to be bullish, but you need the dexterity to flip. You need the method. You need to know when key events are actually quietly occurring in the here and now, and you have to not be emotionally invested in what's happened before and recognize that things are potentially changing. And this is the key problem. So to say shorting is never worth it, because unless something goes bankrupt, you're never going to make more than 100%. And most of the time, one of the best shorts ever that makes 84%, which you could have made with, particularly with judicious use of moderate leverage, huge amounts, you also would have preserved your high watermark level by first getting square, selling out of Bitcoin, and instead of having your core asset in Bitcoin, having it in fiat equivalent and utilizing that as your deposit for leverage shorting, rebuilding yourself back to your high watermark high at the top of the bull market and beyond, and now being in a super strong position to get long. That 3,000 to 6,300 is the trade that nobody took. And I don't think it's over. We've already seen now that we're at 6.8 and potentially going to 1,000. So it could have been more than 125. But remember this, it encourages people to be buyers only and to hold. They don't see that they will never pick that low because it's doing something that makes them afraid, and that fear is not something that sees you be a buyer. It's the absence of method. And in fact, I wouldn't have bought that low at any point. You never get the low. You need some sign of technical strength, and you have your own belief systems to overcome. So we're far from executed perfectly on the bottom. I wait for further confirmation. But let me say, the key levels being run at the moment, which are highly volume by price, are significant. Most people are saying, so, is it a bull market now? In my view, it's almost certainly, for Bitcoin so far, a predominant move to the upside, and is implying the high likelihood to the 90s of being a bull market. So 80 to 90% bull market now confirmed, now that it's taken. It is an invalidation of bigger setups on pound, gold, and the euro that could have still been in place. So the run out of those levels, so that is bullish for us in terms of our method. So people are going to be too late to everything. They were too late to get square. They were too late to ever get bear, if they ever made it there. Most didn't. And they will be too late to get back to the bull market. And a method helps you be earlier. It helps you have fundamental process that you apply, that sets aside emotion that you give higher priority to, and sees you getting into a bull market while other people are in disbelief and still wondering if it's going to make new lows. That is the key element. And that tweet, whilst mathematically correct, it gets to the wrong rationale. Getting square at the top, getting bear during it, requires technique, and requires to be an advanced trader, and requires method, in our opinion. But if you do it, you will not only sustain your capital base, you will rebuild it for not getting out at the perfect top. Forget picking the bottoms and the tops. This whole discussion or tweet is all about top and bottom calling. It just never happens to 99.9%. And when I've done it, it's been because I was applying method, not trying to pick the bottoms and tops. So actually it happens way more often for me by applying method than it now does than when I ever tried to do it. So forget it. It just doesn't happen. It's a technical discussion. The amount of people that were buying at that level were trivial. And the key moves only came later anyway. So method over everything. Recovery ladder. If you stayed in, and that way you were long at 3,122 because you actually ate the 85% or 98% if you're in NEM, and if you're in Ethereum, you're in the low 90s as well. 100% on your 8%, what's left of your high water mark takes you to 16% of what you once had. That's 100%. Even if it goes 200, 300%, you are still going to be sub 50% of what you once had. And that was because you perma one view on the big time frames. You only have to trade or invest on the big time frame and understand what market you're in to be a winner in here. So good guy, don't know him, very interesting mathematical point. Nothing he said is invalid. My concern is for the conclusions that people will make from a tweet like that, and the value of investing has a point where you take off and you preserve capital. Always, particularly in high volatile markets where huge gains are dropped in very short time periods. To not expect a move that could take 80% of your money is foolhardy. And it can and probably will happen again to the tune of 50, 60, 70% plus in future. But it might be from a dizzy height. Okay, that's it from me. I just want to make it aware. If you want to see the full webinar, by the way, I will post the auto webinar link in the notes below, where we cover not only the recovery ladder, but capital preservation and being set for the new bull markets. And it's all in the notes below. I hope that's helpful to you. And in my view, most of the pennies have dropped for the end of the bear. That doesn't mean it's instantly a runaway melt-up bull. What it means is it's probably a building bull market. Bye for now.